downturn. Give me your assessment of what we're seeing across the country in terms of commercial real estate.
Yes, we've seen a very nice resurgence in real estate values really across the country, but especially in the coastal regions that did definitely take a very large hit during the global financial crisis. Fundamentals remain strong, and many of the publicly listed real estate companies out there have recapitalized in some form or fashion, which makes them very strong today with very strong fundamentals and recovering valuations.
One of your big holdings is in office properties. Interesting, given that the unemployment rate is still very high, so it almost sounds counterintuitive.
It certainly does, but office fundamentals, at least in the coastal areas, in CBD type of markets, have held up very strong. Companies have certainly rationalized different parts of their businesses, but they have been, for the most part, unwilling to give up a lot of office space. So we've seen that vacancy rates in office have remained or occupancy rates in office have remained quite strong and are getting stronger.
Tell me how you might readjust your holdings this year. Where are you finding some impressive values as you look out for 2013, sector-wise?
Yeah, first of all, from a big picture perspective, we are finding quite a bit of value in smaller cap names that have outsized growth rates and better valuations or lower multiples. In terms of sectors, we run a sector neutral fund, so we don't really take sector bets versus our benchmark index, the MSCI REIT index. But we are finding unique values in oftentimes smaller cap names that are overlooked by the market that have strong growth rates.
And what are some of those names?
Some of the types of names we like are National Retail, which is a net lease company, has very long net leases with, they're essentially the landlord to convenience stores and restaurants and some types of standalone retail. These companies pay out extremely high cash flow yields or pay out dividend yields that are extremely high. And I think in an environment where people are worried about rising interest rates and duration risk within fixed income, these higher yielding net lease companies like National Retail stand to do very well because we expect that their dividends will rise in excess of or commensurate with GDP, unlike a static coupon that you'd find in the bond market. So investors looking for yield are looking for yield, that really growing yield in this type of a market where there is some concern about rising interest rates.